Okay, let's dive right into this explainer. We are going to put Addus HomeCare through the absolute ultimate stock analysis gauntlet. We're talking stripping this company down to its fundamental core using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then, just to keep things grounded, we'll cross-reference all those findings with modern discounted cash flow modeling.
Here's our roadmap for today. First, the contender. Then, the Buffett lens, the Lynch lens, the Graham lens, modern math, and finally, synthesis and verdict.
Section 1. The contender, Addus HomeCare. Now, Addus is a major player in home and community-based healthcare services. I want you to anchor this number in your mind right now, $92.70. That's their current stock price, which gives them a market cap of roughly $1.7 billion. Every single fair value we calculate today using our guru frameworks is going to be measured against that exact figure.
It's really interesting to see how they actually make their money. They have a massive reliance on personal care. Out of their $363.6 million in total revenue for the first quarter, a whopping $281.1 million comes strictly from non-medical assistance with daily living. That core business is supported by about $65 million from growing hospice operations and a much smaller $16.7 million home health segment.
Let's move on to Section 2, the Warren Buffett lens.
So the Oracle of Omaha is always hunting for durable economic moats, consistent earnings, and rock-solid management, right? Well, Addus actually shows a pretty sturdy moat through regulatory barriers and scale. They also boast a 5-year earnings per share compound annual growth rate of over 16%. Return on equity sits around 2.25%, but honestly, their debt profile is where they really truly shine.
I mean, look at this balance sheet strength. Addus has a debt-to-equity ratio of just 0.08. Now, Buffett generally prefers leverage ratios under 0.5, so Addus is completely crushing it here. They carry only about $91 million in long-term debt against over $1.1 billion in equity. That is incredibly rare.
Buffett also loves what he calls owner earnings, which we usually approximate using free cash flow. In Q1 alone, Addus generated over $50 million in free cash flow. If we just annualize that out, you are looking at a $200 million cash-generating machine. Buffett would definitely be interested, though knowing him, he'd probably demand a slight discount from $92.70 just to secure his strict margin of safety.
Okay, so it passes Buffett's quality check with flying colors, but does it have the growth profile to satisfy our next guru?
Section 3. The Peter Lynch lens.
Peter Lynch famously categorized companies into 6 buckets, so he knew exactly what kind of story he was buying into. Addus classifies as a classic stalwart, or maybe a borderline fast grower. They have a historical 5-year revenue growth rate of 13.2%, though Wall Street does expect a slightly cooler 9.2% earnings growth over the next 12 months.
Using Lynch's famous PEG ratio, where we just divide the forward PE ratio by that expected growth rate, we get some really interesting results. With a forward PE of roughly 14.4 and that 9.2% expected growth, the PEG ratio sits at 1.56. Now, Lynch loved PEG ratios under 1.0, so at 1.56, he'd likely see it as slightly overvalued for a pure growth at a reasonable price play. However, he would absolutely love the pristine balance sheet and a lack of institutional crowding. For Lynch, this one's probably a solid hold.
Section 4. The Benjamin Graham lens.
Benjamin Graham uses the ultimate defensive checklist to make absolutely sure he never overpays. Running the numbers, Addus passes almost every single metric. Adequate size at $1.7 billion? Pass. Strong financial condition with a 1.83 current ratio? Pass. Positive earnings? Pass. It actually only fails the dividend test simply because they don't pay one, and multiplying their modest PE by their price to book yields a number that is safely under his maximum threshold.
So, the crucial point here is calculating Graham's absolute intrinsic value. We use his classic formula, the square root of 22.5 multiplied by earnings per share multiplied by book value per share.
When we plug in Wall Street's forward EPS of $6.44 and the company's stated book value per share of $59.80, Graham's formula gives us an intrinsic value of $93.07. That is practically identical to the current $92.70 price. Graham would look at this and say the stock is priced exactly at its fair value today. No way!
Section 5. Modern math, DCF, and comps. Okay, stepping out of the history books, let's build a modern discounted cash flow model. We have to make some educated assumptions here.
We'll use a $200 million base free cash flow, projecting a pretty conservative 9% growth rate over the next 5 years to mirror the expected EPS growth. We'll discount that back at a standard 9% weighted average cost of capital and assume a 2.5% terminal growth rate for life after year 5.
Our base DCF calculation spits out a fair value of $115 per share. Now, that is conservative compared to the consensus Wall Street target of $131. Analysts cover this stock using comparable company multiples, basically comparing Addus's EV to EBITDA against its industry peers to justify that higher 40% upside.
And this perfectly illustrates the fragility of modern math. If interest rates drop and we use an 8% discount rate, our DCF fair value skyrockets to $140. But if inflation stays sticky and we have to enforce a strict 10% discount rate, the fair value drops to $98, which is just above where it trades today.
Section 6. Synthesis and Final Verdict. The gauntlet is officially complete. Looking at the summary, Addus is currently trading at $92.70. This is exactly in line with Graham's strict intrinsic value, but it sits at a distinct discount to our base DCF model of $115 and an even steeper discount to Wall Street's comps-driven $131 consensus.
When you're making an investment decision here, it really comes down to weighing the massive strengths, like incredibly low debt, huge free cash flow, and an undeniable tailwind from an aging population, against the ever-present risks. You got margin pressures and the looming threat of government regulatory changes, specifically things like the upcoming 80-40 Medicaid rule that will require 80% of payments to go directly to caregiver compensation. So, what's our final verdict? Addus HomeCare is a solid moderate buy at $92.70. It's a fairly valued stalwart with an ironclad balance sheet. You'd buy this for the steady, long-term demographic growth in home care. Now, if you strictly follow Graham and demand a 20% margin of safety, you'd probably hold off until it dips to $75. Still, the modern cash flow suggests the downside risk here is remarkably well protected. So, the question I want to leave you with is this. In an environment of shifting government regulations, is a pristine balance sheet enough to guarantee future dominance?